everybody. Welcome to CTO Craft Bytes. I'm Guy Hutchinson. I'm a CFO and the host for today's panel about CFO partnering with a CTO. So we've had a very good take-up for the event. It looks like we've got well over 20 people online right now and more joining as we go. So let me introduce the topic for this session. So the topic for this particular webinar is how a CTO or a tech lead can partner with a CFO or any finance leader that you might have. If it's your first time to CTO Crafts, I should explain a little bit about the group. So broadly speaking, it's a tech community built around opportunities to mentor and learn. There's a very, very busy Slack group, and we have a membership of about 1,400, and I believe it's one of the leading tech groups in startups in London and the UK generally. In terms of the type of events, I think this is the first of the sort of non-pure tech events, and so I'm really pleased that we're talking a little bit about finance. We can bring these events partly because the group has sponsors. So AWS is the sponsor, and they enable us to run things of this type. So before we go ahead, let me just do a quick intro of our two panelists, Steve and Klaas. So firstly, Steve Alexander. I'll do the short intro. So Steve's worked in a series of senior product and tech roles in startups and PLCs and consults on agile development with a large number of companies. Klaas Ardinois is a CTO and trusted advisor for startups and SMEs, and he has a focus on technology and broader corporate governance. So let me just do my intro, and then I'll let the panelists do their broader background. So I'm the founder of the leading startup CFO group in London. We have around 600 members. We're called Startup CFO. If any of your finance leads are interested to join, I'll do the unashamed plug in channel. So if you send them the link that I've just posted, they can find us there and apply to be a member of our group. We have about 600 members, and the focus is predominantly on VC-backed tech businesses and businesses which are disruptive. So my plug over, let's allow our panelists a fuller introduction on their background. Let me hand over to Steve.
Oh, hi. Yeah, so I've been a member of the CTO Craft community for a few months now. I'm actually in one of the mentoring circles, and there are many questions that come up where there's like finance and technology have this relationship which impacts both, but it does so in kind of unexpected ways. So that's become very interesting to me of like how to navigate that, how to bridge those kind of worlds. A lot of times where things get difficult, it's because there are just different ways of thinking about things in each camp, and the communication isn't happening. So I think a lot of times making good decisions is about having that communication. My background involves actually writing code as well as leading kind of engineering teams and product teams and that kind of thing. So I feel like I've still got quite a good connection to what happens in teams building software as well as the kind of overall thing.
Fantastic. Awesome. Klaas?
I think much like Steve, I have a history in writing code and sort of being very in touch with technology. And then came up through the ranks in companies of all sizes, and at some point in an engineering manager's career, you hit finance and sort of the weird people who run the numbers. I kind of took the plunge, and I ended up doing an MBA in corporate finance to really understand, what is this finance magic that they do? How does it work? How do you finance a project? Why do you make a decision to invest? How do you appraise investments? And so I kind of really took the theoretical course to an extreme. And ever since, I've sort of been dabbling in and out between this mixture of, technology and the financial aspect of it. The corporate governance side then comes in as well around, how do you make sure that you can justify all these decisions? And so weirdly, I've usually have a pretty good relationship with the finance department because I kind of speak their language half the time.
Yeah, fantastic. Yeah, so So let's dive in, guys, and pick one of the sort of key areas where the CFOs and CTOs are likely to like collaborate and work on a single thing. So I guess at the start of each year, any tech business, be it a startup or a scale up, they need to go away and build a budget, right? And it's something that finance people end up logging quite a significant number of hours on, and it forces them into this sort of cross-departmental collaboration where you essentially say, hey, look, we're building this great business. So actually, what is it that drives growth? What is it that drives transitions in terms of pricing or ARPU or something like this? So it's kind of one of those really decisive moments where the CFO is going to come and find you and talk to you about what your roadmap looks like and what that might infer for what the business will achieve. So Steve, maybe starting with you, how do you find the kind of budget dialogue and how that works?
Typically, well, partly it's like really straightforward and simple in many cases, because we've got a number of teams that do software development, and they are permanent salaried employees perhaps. And so that's not going to change. So in a way, it's like saying, well, we have committed to paying for these people to do this work. Sometimes the voice that's missing from this conversation is the product voice, because that's, if you have a distinction between technology and product, it's product where you've got the ownership of the roadmap and the sense of return on investment of what's going on. So I think it needs to be this kind of three-part discussion with finance, product, and technology, where technology is saying we're the engine that's kind of moving things along. Product saying, where are we steering this? And where's our roadmap? Where are we going? How do we expect to get a return on this? And then finance is making sure it all continues to make sense and it's actually a good investment.
Yeah, so that sounds like your idea would be that the finance person's making the effort to say, grab your product lead, grab the tech lead, collaborate on sort of sketching out exactly what they think will be delivered so that the two things are not divorced.
Yeah, I think quite often in companies, quite often what happens is you get this kind of semi-anonymous request to do a budget. And then individual departments that try and do this budget on their own, more or less, send it back. And then finance has got this unenviable job of trying to collate them and make them all make sense together. And it becomes this very long and painful process. Whereas what I think you want, which doesn't happen often enough, is where you're sort of almost doing a budget together, because it is the same thing.
Yeah, and that danger where you think the request to participate in the budgeting is show me what you want to spend, and then the finance person will kind of tell you what you can, but without the involvement in actually what does this resource actually deliver.
And finance often gets cast as the villain, and that doesn't always help.
Exactly, and I think it's to an extent, it's what creates a lot of, particularly in bigger organizations, it creates a lot of very weird dynamics. Like I remember the very first time I was part of this whole budget cycle, I gave my numbers, team of 5, 1 year, here's what they cost. And my VP Eng went, okay, fine, I'm going to add 20% before submitting this because they're going to come back and ask me to cut costs, and then I'll drop the 20% off. You keep your 5 people and everyone's happy. And it's like, what a messed up process is this? This is a game of chicken where I'm going to ask for a high number because they're going to ask me to spend less. And like, it just it's completely divorced from the reality of we're actually trying to build a piece of software here with a group of people and a kind of a known roadmap.
Yeah. So like really, you kind of need a different framework to think about how to capture those resource requirements, because the finance person does need resource requirements, and there's only so much cash to go around normally, right? So things are finite, but you probably need like the shape of the narrative should start with how does product and tech drive the business to help the business achieve its objectives before anybody fires a spreadsheet around.
Yeah, like I think of a budget pretty much the same way as I think of a technology roadmap. It's something that projects out in the future, a possible path that we could go down to with a whole bunch of assumptions around that. And as long as we're all clear about two things, one, it's based on a whole bunch of assumptions, which may or may not be right. And the further out in the future we go, the less certain we are about how correct we are. As long as we all agree on those sort of state of play, we could get to a very good result. But I think there's a fear when it becomes a spreadsheet that it becomes about the pennies rather than the sort of roughly that's where we want to go to.
Yeah. So I mean, I think I broadly agree with that, and it's probably that a lot of these things are done under great time pressure, and time pressure tends to sort of shrink down how open-minded people are about how to go about solving something. I mean, one question I've got is that if you look at it from anybody's viewpoint, whether it's the CEO, the CTO, and CFO, everybody's dealing with uncertainty, right? So, you know, even these businesses with a 5 or 6 year trading history still have massive uncertainty. And so, like, how do you think you could have a dialogue with the CEO and the CFO about new product, extra resource, doing maybe more releases than you did last year? How do you deal with that uncertainty?
I mean, that's a really good point for right now with coronavirus and limitations on international travel and all sorts of other kinds of uncertainty, Brexit. You know, I imagine that if there was uncertainty 12 months ago, that's been like quadrupled right now.
Yeah, for sure. And Klaas?
I think one of the ways I look at this is almost in sort of war game scenario where you go, look, our baseline is that we keep the same X amount of people, and sort of, you know, or even we do a zero budget and we just build up what we need. But then we start playing, well, if X happens, if this scenario unfolds, we're going to take or add or remove part of the budget and spend it over there. And so you're almost building out kind of an options scenario as opposed to a straight line projection, if that makes sense.
Yeah.
I wonder, Klaas, could you say a bit more? You mentioned the phrase zero budget there. Could you say a little more about what that is?
So a zero-based budget is where you kind of throw away all the previous year's history and just start from zero and build up, I actually need these things to achieve that goal. Whereas I think particularly under some sort of time crunch, there's a habit of going, well, I'll need the same thing as last year plus one more.
Yeah, it's interesting, Klaas. So zero-based budgeting became quite fashionable at a time when there were a lot of established incumbent businesses where essentially the budgeting process ended up justifying things that were status quo. And so by sort of starting at zero, you say, well, actually, do we need these 15 people anyway? Powerful tool. Although I have to say, I have never seen it used in a startup, interestingly.
I mean, I've thought about this because in the last 6 years, I've spent literally going from day one in a startup to 6 years on. And our budgeting process has evolved from me and the CTO and the CEO and the CFO kind of just sitting down over lunch and going, same as last year, yeah, all right, I'll do. To do we need these people? Should we add more? Should we add less? And I think it's almost impossible for us to plan out a year, let alone 2 years in terms of a budget. So you're kind of falling back on the zero base of, do we need these people to do what we want to do? Yes or no, add more, add less. And so kind of zero base is almost the implicit default for us as opposed to the other way around.
Yeah. So actually, I think kind of zero base is quite interesting, right? So probably 2020 is a year that's had more uncertainty in it than any year in the last 100 years, right? We're dealing with times that are completely unlike anything we've seen before. And I guess as we go into November, people are going to start to produce a budget for 2021. And many of those businesses are going to be probably remote first businesses by then, like whether that's a formal decision or just something that they've drifted into because of coronavirus, many will be. And that will open up questions, right? So there'll be CFOs that are budgeting for a dev team and the CTO will be asked, well, I know you need 15 developers and we've been paying 15 developers who are based in London, but if we're remote first, do they have to be? And if we wanted the best people in the world, where would they be anyway?
Yeah, I mean, you've got to take into account the coordination costs of doing that. I mean, there's the cost of change. It takes time and effort to build up the culture of a team so that they can work effectively together doing something complex like software. I mean, the challenge with software is if it's wrong, you find out because it stops working. So it's kind of challenging. And I think sometimes that point fades into the background and like the costs of rebuilding a team from new people or in new places isn't taken into account. There's also just the coordination cost of, if you go distributed, you've got to have people in similar time zones, because otherwise you rely a lot on writing things down to pass things between people every day, and it becomes difficult. So I think there are opportunities to look at the growth of the team, and with people working remotely and not in person a lot, but it requires a bit of care. It's not just the numbers or the salary numbers that count. Yeah,
and I think on that point, I would almost argue, if that sort of gets to its logical conclusion, is that you'll end up with near-shore teams or even offshore teams, not sort of the traditional Indian offshore model where one massive conglomerate gives you a number of people, but kind of a dedicated team in place, effectively part of the company, but not based centrally in London, but based somewhere where salaries are maybe a little more acceptable.
Yeah. And like, I guess with, CTO Craft's heritage being involved in mentoring and coaching, the type of things that you need to do as a leader when it's very difficult to get everybody in one room, like, it's kind of different, right? Like even doing a stand-up, right? Doing a stand-up where you're all physically present, there's something quite good about that for bringing out issues and being able to talk about challenges. And the minute you're trying to do that on a call a bit like this with people in different time zones and things, it's somehow not quite the same.
Yeah, sorry, go on, Steve.
Well, as well as salary, we've been talking about salary quite a bit. When you're talking about a service where you're trying to grow the number of customers you've got, there's also the issue of are you buying machines for a data center, or are you trying to budget cloud costs, where it's like, well, how much we need to spend on cloud costs for this is going to depend on how successful we are. So how do you do a budget? Like, how does a CFO want to see a budget where it's got this kind of variable in it which says how many customers we get? Because there is a relationship, right? It's like, this number of servers per 1,000 customers or whatever.
Yeah. And like, do you feel that there's a minority of businesses where the tech team are able to identify the features, essentially, like the tech team launching product features, is a true kind of revenue driver? Because I think for sure I see businesses on the outside looking in where they roll out feature after feature after feature, and then they reprice, and they probably reprice 20 or 30%, and that looks incredible. It's expensive when you've got to pay the bill, right? But as a business, it's a really incredible step. Do you find that the technologists get involved in that narrative that ultimately what you're building is towards a more valuable piece of software?
Yes and no. It's a weird one, because from a cost point of view, clearly, you cost what you cost. You're kind of a fixed cost in that sense in tech usually, because you've got your people and that's it. I think where, at least in my team, where we put a lot of focus is in kind of trying to understand the way our costs scale. So take AWS as a classic example of sort of your cloudy cost. When we add a feature, what's it going to cost us to run that feature versus what do we expect on the user side? And there isn't always a direct relation between releasing a new feature and kind of increasing revenue by X%. But there's definitely a cost side to this where you could go, look, if people really use this, it's going to cost us at the margin 20 cents per day. And I think that gives our finance guys something to work on, where we just kind of go, marginal cost once you hit a certain level is X, and then you can scale it out in your model, and that affects pricing as well.
Yeah, because it feels to me that's one of the inroads to sort of the CTO having more strategic input into the company generally, actually, is that it's the technology that you deliver that has this impact on pricing. I mean, that might end up being more 3-year planning, but essentially every time that you cut a budget, you are doing 3-year planning. You're just doing the first year of that. So.
To kind of give you an idea, one of the things that we did was we were negotiating a fairly large contract with a big telco, and one of the questions we had was, so we sell a subscription-based model, and they wanted to essentially give a year's free. But the question is, how do you price a free year? Because it's clearly not the $4.99 we charge to our customers. And so we went through the exercise in tech to go, actually, you know, at the kind of volume they're talking about, at the kind of usage that we are seeing on the platform from our normal users, we predict that each of these people that they throw in will cost us, you know, 20 cents a month, and therefore a fair price would be above 20 over 10 months. Now, you can go and negotiate this with them to the nth degree on a sales point of view, but there's a hard bottom line where we start losing money if you go below this number. And I think that really enabled our CEO to go out with confidence and go, look, I have my bottom line number. That's the red line where I walk away from the table.
Yeah. I think those kind of dialogues about what bracket you can price in and be successful are super important. Yeah. So like moving on from annual budgets, right? One of the things that I've always found kind of fascinating actually is that whilst the budget's a framework for how you're going to deliver the next 12 months, almost no early stage business really delivers those numbers. They tend to deliver something else because there's so many variables going on. It's not likely that you predict what's going to happen perfectly. And those decisions that you make, whatever, like 4 months in, 6 months in, 8 months in, right, they're actually quite tricky. And it could be that the business isn't growing as quickly as you thought it would be. It could be that product A is selling well, but B isn't selling so well. It could be that you're a bit like Zoom and Shopify this year, where the business is just taking off like a rocket ship and everyone's struggling to keep up and fulfill those orders. So, you know, how did you feel that the CTOs get involved in those kind of like big kind of mid-year decisions?
There's a mindset thing here that I think plays in. Like I don't know whether I'm overstating saying that CTOs and CFOs typically have a different kind of mindset, but there's certainly I experienced resistance to doing, as you said, doing a budget at the start of the year that you know is going to be uncertain. That just feels like pulling teeth. It feels really difficult to do, because what we sort of want to do is to say, well, this is all uncertain. Here's a massive kind of tornado chart, a funnel of uncertainty that we'd like to play with. But of course, that's very difficult to deal with when you want to produce some predictive accounts of some sort. So I think it starts off just with feeling like we're in foreign territory, trying to just work on that basis, and then to revise it. It's like I don't know how it generally feels like we've done something wrong. When we don't match these numbers that we've felt like we've had to make up to some degree at the start of the year. So it just feels like a very awkward conversation to have. I wonder if there are any ways of making this better. I don't know.
I tend to tell people when I'm budgeting or planning that I'm broadly in the business of being wrong. I'm going to do like a huge amount of work and I'm going to be wrong. And I think somehow that lightens the decision you have to make, where the business is not going to be exactly as you thought it was, and you might have to be making a few adjustments, whatever, even 3 or 4 months in. And I think openness about the degree of uncertainty that everybody's involved in is probably key, right? Because once you're open about that, nobody's shocked, nobody feels that they've done wrong because the business isn't exactly where you thought it might be.
And I think one of the perspectives that I've always thought, at least for myself, was very useful, was to think of a budget as a roadmap for finance. Right? It has all the same sort of problems that we encounter in a product roadmap. You know, there's uncertainty, there's stuff's going to change, there's going to be new requirements, things aren't going to work out. It's just that you happen to express it through something that looks like a really exact number, but beyond that, you've got the same sort of problems as our roadmaps would have.
Yeah, exactly. So I think the way that the CFO sees it is that you kind of have to have one to satisfy investor needs. I mean, actually, so far we haven't really, talked about that. Investors, particularly when things are not going quite to plan, they can take quite a lot of management. So you need to have one to manage the investor relationship with the business as the year pans out. And the budget contains a framework for what you might do. But I think the word might is quite important there, because the chance of being right is close to zero. And so essentially it's a framework for stuff that might or might not happen. And if those things don't happen, then you'll do something else.
And I think it's one of those where, going back to sort of, because it's estimations at the end of the day, and look, every developer is both horribly afraid and really good at estimating, right? We're afraid that we're going to be held to the exact estimate, and we're really good at dodging what is the exact estimate. And so I think I use that same idea with developers as I use with finance. It's about that trade-off between accuracy and precision, right? You can be incredibly precise, to the penny, but very wrong. Or you could be accurate to the nearest 1,000th, not be precise, but still be right. And I think it's finding that trade-off. Clearly, accurate to the nearest 10 million for most startups is not good enough, but equally, to the penny isn't where you need to be either. And I think it's just kind of trying to understand those levers you can play with.
Yeah. So I find that when the dialogue's about levers, that's the bit where people can visualize broadly the same thing, right? So I mean, one of the most common levers, and I'm not sure of the CTO Craft group how many of the tech people are in like Series A, Series B startups, but in that kind of seed Series A window, it's actually very, very common that you have a product that's doing well, but maybe not as well as you need it to do to meet people's expectations. And so you begin to have this dialogue about, hey, look, maybe we can meet the customer's need with something new. And then something new might be like a variation of the existing product. It could almost be a brand new product, right? And there are, books and books written about all the famous pivots, and there's lots of examples, right? But I mean, like, how do you guys feel when you get the CFO, the CEO talking about a product pivot or a new product kind of midway through a year, and they're expecting you guys to kind of recut your resource to try and support something like that?
Yeah, I think it is very tricky, because I've been in conversations where the managing director has said, well, there's an opportunity for us to grow this product in a particular way to do this new thing. So we've talked about it. We reckon it's going to be about 4 months' work, and I've been involved in this conversation. So it's not an estimate plucked out of the air. But then it's like saying, so can we just hire some people for 4 months to do this work, and then contractors or whatever, or an external resource of some sort? And that's where it gets tricky, because there's an overhead to working with contractors, and then bringing that work in and having your team that's a salaried team deal with what other people have done. That there are all sorts of unknowns and overheads there. Ideally, we'd want to say, well, we want to have a team that is a permanent team who is in this for the long run, working on this new area. But then that's a commitment to be employing people for that period of time. It's really hard to build a culture where you've got salaried staff who are there for the long term and dealing with stuff and looking for the long term in terms of things like technical debt. And then you bring in people temporarily who have much different motivations, or they've got different incentives there. So it's challenging. I find it often very challenging to communicate these more sort of structural, cultural issues around, that have a really big impact financially and in terms of the product for the long term. But to communicate that, where what we really want is some sort of flexibility to grow and contract along with the opportunity. So it is hugely challenging. I've got a few ideas of how to solve it, but maybe Klaas has solved it already. I don't know.
Not quite sure I solved it, but I think part of what you're hinting at is a difference of perspective. I think when I talk to people who are not familiar with software, they often think of software kind of like, building a house or building, or creating a piece of art where, you make it and that takes effort and time, but then it's done and then you're kind of, it's there. You don't have anything left to do. Whereas I always have to then sort of turn it around and go, actually, building software is like mowing the lawn. Your lawn is never mowed. There's always a next phase coming down the line. I think it's that kind of mindset where, unless you're an agency who kind of, builds an app for a client and forgets about it, quite often you will end up owning and maintaining and running that software.
Yeah, and like in terms of the people that you bring in to your teams to actually get these things delivered, is it a different type of developer who likes to improve a product over 3, 4, 5 years, like always finding all those improvements and really deeply bought into something? Is that person different from the person who's happy to build something new from scratch one day? I mean, are they different flavors?
That's a whole kind of panel discussion on its own. There are lots of models for understanding this. I mean, there's a guy called Simon Woodley who popularized a model talking about town planners, people, town planners versus pioneers, versus, I can't remember the other one, bureaucrats or something. But this idea of people who have different tolerances for uncertainty and different interests in innovation. I think typically we end up having teams that have different people in. Like people who specialize in testing tend to have a different view on how things work than people who specialize in inventing new features and breaking things. So I think in a startup, you typically have a mixture of people involved, perhaps weighted a little towards people who enjoy innovating more and enjoy the uncertainty more. As the startup grows, you'll typically attract more people with a sort of small c conservative mindset who want to improve things slowly and keep things the same and are more risk averse. And it gets difficult if you've entered a more sort of conservative phase and then you want to change things. You want to change things up. You can end up with this kind of culture clash of doing that. Whereas what you need is something which integrates. So it is very challenging. And I think sometimes these challenges don't get reflected in the more dry numbers that we look at financially.
Yeah, and I think the model you mentioned, I've heard a variation on that, which is essentially you start out with a group of commandos, people who are happy to be dropped behind enemy lines and just go from 0 to 1 in your software. And then as you grow, you need to bring in some sort of police and kind of middle layer of management to start to guide the commandos to be more efficient. And the commandos end up hating it and leaving, and they get replaced by infantry who just soldiers on. And I kind of, as your business grows, you can see that. Like, I remember the team I brought in on day one at Azoomee was, stereotype guys in the garage, commando style, we're just going to hack this thing together and it'll work. And they did all the things wrong that you'd expect with that kind of attitude in terms of code quality and in terms of robustness. But the MVP was delivered in 6 months on a shoestring budget, so everyone was kind of happy. And as we moved on from that, we brought in people who focus more on the process side of things, people who focus more on code quality. Our pace of delivery sort of nominally slowed, but I know that the quality we gained was entirely worth the effort we made there. And
yeah, makes sense.
To your point, Steve, I think to your point, Steve, that dynamic doesn't get reflected because from a budget point of view, these are all people who earn between 50 and 100K.
Yeah, and probably the finance person isn't even aware that, commandos are different from your rank and file troops and that they both have lots of value, but you wouldn't want to ask a commando to do a rank and file role or vice versa. So there's something interesting there. And also I've never seen that in a spreadsheet for somebody's budget either. Finance people just don't get it.
I would happily submit a budget for like 5 commandos and an infantry battalion.
Yeah, I can see that. That's gonna go down well. Very good. So like moving on from the kind of decisions that you might make midway through a year, let's talk a little bit about one of those areas where sort of CFOs probably keep their cards fairly close to their chest when it comes to stakeholder management, particularly shareholders and board directors. So they are inclined to spend a certain amount of time making sure that the right impression is made with investors, that the business can fundraise again. And it's some of that stakeholder management. They may come to the CTO to talk about the capitalization of technology and one or two things of that nature. And so, obviously, if it's a case that EBITDA is the measure that the business is focusing on its success measure, when you capitalize, you improve that measure, you will make a profit more quickly, essentially. But it does mean that many of your other measures do look somewhat different, and there might be some more work to do. So how have you guys capitalization?
I'm worried. Sorry, go ahead, Klaas.
I think I'm going to say the same thing. Like, it might be worth explaining some of the finance jargon right there.
Okay.
You kind of swirl it around.
So sorry, yeah, I forgot. I thought I was doing a finance panel. So EBITDA, so it's earnings before interest, taxation, depreciation, and amortization, which in most startups means that essentially the stuff that you capitalize, which means you put it on the balance sheet, would ordinarily be your computers, your hardware these days. But it could be your software. You could take some of your expenses, including your payroll, and each month you would capitalize it, and it would not hit EBITDA, your measure of losses or profitability, because the amortization is the right through the deferral of the cost for your CapEx. Did I do it okay?
Works for me.
So, Steve, any experience on this area?
Yeah, a bit. I think it's often very attractive for an organization to capitalize, so to do this thing of spreading costs over several years. And it kind of makes sense when you're doing something new. Like, let's make a new piece of software that we're going to use and sell or have some internal benefit over the course of several years. It would look wrong in the accounts, perhaps, if we accounted for the whole cost of that just in 1 year. It would make that first year look, less profitable. But really, if you look at what the business is doing, the business is doing the same thing in the second year, maybe a little better. And so it kind of makes sense. I think the problem comes in where in software, most of the cost of making something is in the salaries of people who are making it. And if we start wanting to capitalize the salaries, or spread 1 year's salaries across 4 or 5 years of accounts, there's lots of overhead in doing that we need to do to make it work for the accounts, to make it auditable, to make it legal, essentially. Things like having to do timesheets for developers. Well, developers hate doing timesheets generally. I've not met someone who likes it. And there's a risk that if you start doing this, the people who the people who are more skilled and perhaps less tolerant of timesheets will leave over time, and the people who are less skilled and perhaps more tolerant of timesheets will stay, and you end up having this unfortunate dynamic on your kind of development department.
Sorry, Steve, go on.
I guess the other thing is just the sheer overhead of doing the paperwork required to meet the requirements of CapEx. If you're doing waterfall kind of projects, it's quite easy because the accounting rules have kind of been written with waterfall in mind. But if you're more agile, like the more agile you get, the harder it is to bridge that gap between accounting rules and what actually goes on in software development. So you end up, it's possible to do, and there are a few really good guides on how to do it out there. But it requires, I think, more time and effort from the software development, but also more time and effort than people think in communicating with finance about the decisions being made. Well, when it comes down to it, like if you're doing something like a retrospective, can that time for a team be capitalized or not? Many accountants I've spoken do say not, because it's about improving the functioning of the team and it's more of an operational thing. But some I've spoken to said, well, if it's about improving how we are specifically developing this, they came up with a justification of why it could be capitalized. And it seems to be that as long as the CFOs can stand behind that and document it and justify it to auditors, either way could be fine. So there seems to be a lot of flexibility in doing this.
I think you've touched on 2 points there. I think one is timesheets aren't for the sake of timesheets. They are for the sake of understanding which portion of the work could go into this capitalization process and which portion of the work definitely can't. And so part of me wonders if there's a better way to account for this. If we tracked from take the traditional Jira, if I told you we produced 20 stories and 5 bugs, well, clearly 1 in 5 wouldn't be capitalizable because bug fixing is typically not a capitalizable piece of work. So I think timesheets could be twisted around by looking differently at how we measure the work that's done. Because, as you say, there's a fixed cost of, a developer has nominally 40 hours a week, give or take, and therefore we could make a fairly decent percentage split, saying, over a week you've done 3 stories and 2 bugs, great, 40% not capitalized, 60% capitalized. But I think the other point you're on, and I think, Guy, you're probably more or better placed to look into that than I am, is the enormous ambiguity in those rules, those sort of gap accounting rules. I know they're meant to be straightforward and clear, but they're anything but usually.
Yeah. So I think what I'd say on this topic is that if you were to meet the people that draft those accounting standards that are supposed to be sort of applied across this incredible spectrum of businesses with various capital type activities, they're so so far divorced from the kind of work that we do that like the fact that the rules are not very practical is not really a consideration for them, because they're just trying to find sentences that can be interpreted in a whole bunch of different contexts. And then you have the awkward thing where the auditor interprets the sentences towards, hey, look, you've got to have timesheets, and if it's website development, it's not going to count. If it's not got an associated revenue stream over 3 to 5 years, it's not going to count. If it's bug fixing, it's not going to count. And for sure, I mean, like the only people that enjoy doing timesheets are lawyers, and that's because they charge per minute, and it's a feral whack, right? So when you're just receiving your salary, as developers are, of course, people do not have timesheets. So I've got a lot of sympathy. I mean, my standing on this is, and probably mainly because my heritage is mainly in businesses in this sort of Series B window, so probably the first 5 years of their existence, is that one of the challenges when you do capitalize, and probably only a fraction of mine do, maybe a quarter of them would do, is that you've essentially committed to something that more established businesses do. And so you commit to a large amount of work that's split between finance and the tech people that you might not have really jumped towards if you had really understood how much work was involved. And even after you've done all of that, the challenge that you have is that you'll be in the board meeting and you might be describing that the business has got operating losses of 100K, but a cash outflow of 140K. And your investors are going to ask the question at every board meeting. So what is the 40K difference? It's like, well, we capitalize the tech, so we pay for these developers, but then their cost isn't on the P&L, it's on the balance sheet. Oh, yeah. And so you actually create something which is sort of slightly counterintuitive in your key financial statements. And so I'm like, personally, I'm not really a fan, but for different reasons from the type of practical challenges that both of you two have.
And I think you're also coming on to some other interesting topic is that there is the sort of, gap accounting that you have to do for HMRC and the likes. And then there's the internal management accounts, which take a lot more liberty in how you treat all these kind of costs and where you put them. And like I know quite a few early stage startups who have the complete opposite view. They just go, you know what, development 100% capitalized. It doesn't matter if the product is live, if it's bug fixing, just all that cost gets capitalized.
Yeah, and that doesn't present any short-term danger, right? Because no one is checking your numbers at this point. But if the business takes off and you needed to do like a 3-year audit pre-IPO, trust me, the person who's got to deal with that with your auditor is going to have a real headache.
Right.
Probably more than half it. Well, more than half it. You probably can't back up any of it, really. So, these things that build on balance sheets, they can become trouble later on.
And as a CFO, if you get that wrong, can you actually go to jail, or did I misunderstand that?
I think you don't actually do jail time, but I think they probably tell you that you have been quite naughty. Yeah, that's how it works. So look, I think actually now is a great time to jump to a couple of questions. So we've got a couple of questions dangling in the ask questions section of the platform. So one actually we've touched on already. So let's just dive in on that one right now. So cost center versus profit center sort of dialogue, right? It's a classic part of how you budget, how you talk with your investors in board meeting, even how you might fundraise. So how do you guys find it's helpful to build a profit center narrative?
I would invoke product here. I just think it's really important that companies look at things not in terms of technology, but in terms of product. And product's this place where cost and profit centers kind of come together, right? In a typical divisional or departmental organization, they sort of come together in the executive team right at the top. The one person who's got overview of profit centers and cost centers is the CEO or the CFO. Whereas when you've got product managers who are sort of empowered product managers, that's where they've got some sort of insight into costs and profits of their product at a more fine-grained level in the organization.
So on that, I'm actually going through the exercise of a group restructure of a company I work with. And so we're going from one single company now into lots of subsidiaries, and we had this exact discussion, right? Because IT or tech development is a cost center, whereas there are other subsidiaries who make the money, right? Because subsidiary A sells the brand of A, takes the money in, but then has to pay the technology for actually building the product they're selling. And so you create this very weird dynamic where somehow, and you guys know I have a pet peeve with cost centers, and it creates the wrong dynamic, and it's sort of the completely psychologically wrong model to think about this. But there is a reality that there is no direct contribution from developers to the upside. That they're not the people out there marketing, selling, and doing that kind of activity. Even on the sort of user acquisition side, they're not there. And so I'm completely in agreement with you, Steve. It's about how do we shift away from this narrative that technology is a separate bucket of costs into actually the product will bring in X and it will cost us Y to develop it, which includes product managers, project managers, development, and operational costs on the AWS side. How do we take that as a cost to develop a product, as opposed to these 5 engineers cost us $200K?
Yeah. So I think I would agree with most of that, and now I really think it through, and it's not often that you sort of get these people all together to talk through topics like this. It makes me realise that there have been very few occasions where I've seen, like, say, VP product CTO presenting with the CFO and presenting, hey, look, we're going to push X, Y, and Z in the next 6 months, and by the way, here's the financial consequence. Like, you don't see that very often. And there's no logical reason why you wouldn't do that, because that's how many businesses would look in the end. It's kind of curious to me that you don't see that happen so often.
It's one of the things that we started doing in how we look at our business and how we work through roadmaps. So I put out a template to the team leads across all our products, and basically went, look, we're going to stop dealing with cost of engineering, because this is not a cost center. What we're going to start doing is you're going to kind of spec out roughly what sort of features you want or which kind of things you want to release, and you're going to work on your revenue model, and the tech leads will give you a rough idea of what it would cost to build this, to the nearest few $1,000s. This is what it will cost, and then we'll just have an open discussion about ROI, frankly.
Yeah. And like measuring ROI on a product release is pretty challenging, right? I mean, like, that's one of the metrics that sort of CFOs be like, well, it doesn't matter how we do it, it's going to be highly subjective. That's the thing, yes. Isn't it?
It is. And I mean, look, in any good spreadsheet, you can tweak it to look whichever way you want.
Yeah.
But I think it's not so much about the outcome, it's about the process of having that conversation of, look, we think doing this will cost X. Does that seem like a good idea to spend X on that potential? Even if the ROI calculation isn't sort of precise, yeah. You're having a very honest conversation about, this is a big expensive thing to build. As a company, do we want to invest our resources into building this? Do we think this is a gamble worth making? Yeah,
and like I often feel actually that language, like about risk, about likelihood, about gambles, right? That always needs to be a natural part of sort of particularly tech startup language. Is that why obsess that the ROI calc can't be accurate within a few percentage points, because it probably can't be. But the fact that you could even get near to an ROI calc that looks pretty good might indicate that you should take the gamble, right? It's sort of essentially, we're not looking at mature businesses that were traded for like 20 years with quite a lot of predictability. We're looking at something that's the right opposite end of the spectrum, where you just need to park the problem that you can't be that accurate about exact returns.
There's this guy called John Cutler, who's a well-known agile leader, and he's tried to popularize the idea of real options, which is taking a principle from financial investment of options, trading options, this kind of thing, and then applying that to the idea of you're doing some development and you're buying an option on having a successful product if that turns out to be a good product market fit, and if it turns out to have worked according to our estimates and that kind of thing, and to try and shift budgeting from being this, let's pretend we've got certainty and then revise that during the year, to being more like, let's look at the options that we are investing in, knowing that there's a different risk profile associated with each option, and then see what we get for that. And so I think it's kind of interesting of like saying, can we shift from this facade of certainty within financial planning of an organization to one where we're saying, let's take account of the risk in some way all the way down.
Steve, that sounds amazing. Actually, if you've got a reference for that chap's blog, if you could post it in the dialogue, that would be amazing. Actually, I hadn't heard of him before, and I very much like the way that frames the conversation. I think it's very, very applicable, and I can see how those trading in the markets with the massive uncertainty that you have in the markets, there's a parallel with the massive uncertainty that you have inside a business, which at some level is still like a marketplace.
Exactly.
And I think that also opens the conversation to, if you think of that as an options premium, your development cost is a premium you're paying for whatever future returns you might get. There's also a discussion halfway through that premium at that point of, do we really want to sink another 200K into this, or has the risk profile changed over time? And I think it's one of the few things that I actually liked about Prince 2 as a project management methodology, is that they really had this concept wired in around sort of continued justification of your business case. Not about the next sprint or the next 2 sprints or whatever short-term goal, but really at core, your business case, your whole reason you're doing this as a company, are those grounds still valid to continue investing in this project? And I feel with all the focus on agile and sort of being nimble, that has kind of fallen by the wayside a little bit.
Yeah, agree on that. Very good. So let's take a final question. Actually, we haven't talked tax, and so Mal has posted an R&D tax credit question. So we only have a few minutes. So let's do it very quickly. How do you guys find the R&D collaboration process to capture those all important credits?
I think, Klaas, you have a little more experience on this.
Yeah, we were saying before we went sort of on camera, like I actually got audited by HMRC for a tax claim. And it's interesting because once they actually do the audit, they are completely unbothered by the financial and the accounting treatment that you gave it, and they really dig into, did you advance the science of whatever domain you're in? Did you really push the boundaries, or are you just stringing together known solutions in a better way? And so quite a lot of our claim, we could legitimately prove that we had advanced that area of technology substantially enough that we could claim the amount we claimed. But there were a few where we ended up in a conversation where they went, look, this is nice, but it's kind of a solved problem that you've just repackaged, and therefore you can't claim for this piece. And so it was interesting to see, all the prep work was around kind of demonstrating we do these kind of projects and that kind of stuff, and we've accounted for them in this way with contractors and firm staff, and all these kind of costs went into it, and therefore our final number is whatever. And then they came in and went, yeah, great, fine, let's talk about the stuff you've actually done. And I was pleased to find, first of all, the audit was done by a third party who knows technology, as opposed to HMRC, who knows numbers. Because we ended up having a really difficult but interesting conversation about how we push technology forward. So back to the original question, how do you account for this? It's really about focusing on which of your projects push the boundaries of what is known in technology. To give you an idea, we did a lot of work, this was a couple of years ago, around edge computing. So, pushing out logic onto the edge of the CDN. Which was brand new at the time. And so there was a lot of uncertainty and not much developed knowledge. So we really contributed on that front. And HMRC went, yeah, that's fine, granted. But then some of the stuff we did internally, they went, no, this is just boring old technology. So I think that dynamic in terms of how you plan for it is really looking at which projects push the boundaries and therefore you should claim, and which projects do not move in that point.
Yeah, Klaas. Like I must say, actually, there are not many CFOs or probably CTOs out there with that level of insight. So at some level, you were kind of almost lucky to have the experience, right?
After that meeting, I didn't feel lucky.
I would struggle to name a CFO who's been through that.
Yeah, I'm not sure lucky is the word, to be honest.
Yeah. Steve?
I think Klaas said it all. I guess the only other thing I'd add is that the mechanics of accounting for R&D tax credits, they seem to be quite similar to what you need to do for accounting for CapEx, in the sense that You need to understand the amount of effort that has been put into various aspects of the software development, except rather than categorize it as like, here's the things according to the accounting rules for CapEx, there are slightly different rules for doing R&D tax credits. So the thing that can be difficult is if you've got a team and you're doing CapEx and you're doing R&D tax credits at the same time, you've got a slightly confusing overlap of different sort of time tracking, effort tracking regimes. And it can just get more confusing because the people who end up having to do this are either project managers or software developers or scrum masters or whatever. And doing one of these is hard enough. Doing two that aren't quite compatible can just be a bit of a can mess with your head.
Yeah, it's strange, isn't it, right? Because the tax people and the accountancy standards people essentially haven't really made the effort to like collaborate, even though that essentially their starting point would be that 50% of it's about the same, but the other half that isn't drives quite a lot of admin. Like it essentially drives a lot of cost and effort that doesn't really add any value. So yeah, it's sort of strange that there wouldn't be a harmonization. But then again, tax breaks often are unique by different markets. There's different governments try to, get one over on the other government by being more appealing for businesses that could choose to domicile in different areas. So I guess maybe there's sort of global accounting standards and localized tax regimes. There's a tension there, isn't there?
Absolutely. So part of our structures, we've got obviously subsidiaries in the UK, and then we have a subsidiary in Germany who has a different way of treating development and how you capitalize and tax it. And it's such a nightmare as a CTO to wrap your head around, like, oh, hang on, so the guys who are paid in Germany have to account in this way because that's how they affect the P&L, and the guys in London have to do it this way because that's how they affect our P&L, and we can claim tax credit on these things but not on those, and it just becomes this unholy mess where I literally spent probably 2 days a quarter with an accountant going through line by line, like, oh yeah, that was done in Germany and therefore it falls under this regime.
Yeah, I must say that when you have a group with the technology occurring in different regimes, it's not appealing from a regulatory standpoint really at all. Awesome, guys. Look, I think we've had an amazing conversation about 4 or 5 really interesting sort of tech meets finance topics, and it's been a real pleasure actually to be part of the CTO Craft virtual event series for the last hour. I think under time pressure, I'm going to have to say, look, Steve, thank you very, very much. You've been an amazing panelist. Klaas, really has been fascinating, both of you. Let me plug your details into the little chat dialogue on the right there, so that if people want to reach out to you, they have your various details. I guess I should thank Andy Skipper for inviting me to participate. I gather it's the first time you've had a guest host, and it was an absolute pleasure. And like I said earlier, I'm involved in running the leading startup tech CFO group. So if you go and have a chat with your CFO after this, make sure that they're a member, and I just dropped the link in the chat box if that's helpful. And so Steve, Klaas, unless there's anything else we're due to say, I think we're pretty much bang on 1 o'clock.
Oh, look, thanks so much for moderating. This has been great to have such an open conversation with the CFO.
Yeah, we should do this again.
Yeah.
It's been fun. Yes. We should indeed. Okay, awesome. Well, look, guys, thank you very much. Thank you, the 30 odd people who have joined us throughout. See you all again soon.
Sounds good.
Right.